time now for the single best chart, and to join me to do this, it's Haran, Segram professor at NYU Stern School of Business. Now, come into my chart here because it's very interesting. We're got the Lyft IPO news, of course, but it does come on the heels as 2019 has been a very low year. Part of this has been the U.S. government shutdown that sort of put a backlog on the number of IPOs that we had seen, and then a lot of this has been, basically pure demand side. I remember we had the Snap IPO a few years ago. That hasn't gone very well. So talk to me about Lyft. The valuation justify for that, to me, between the $62 and $68 a share that we're seeing this morning.
Thanks for having me, Taylor. So I was looking at, when I was speaking to Tom about 2 weeks ago on the radio, I was putting this valuation between $20 and $25 billion. This is my rationale behind it. So when I look at this company, this is a platform company. If you take EV to sales for a typical US company, S&P 500 company, it is between 2 and 2.5 times revenues. But if you value a platform company, the platform companies are anywhere between 7 and 10x of the revenues. So if you take current revenues for Lyft, and you take it forward at a 25% growth rate every year for the next 5 years, that will give you a revenue number between $6 and $7 billion. If you have the $6 and $7 billion at a 5x, that should give you a future value of 30 to 35 billion. If you discount it back at the cost of capital that I estimated, the value comes between 20 and 23 billion. So as a platform company, so we have to be a bit careful about this. The reason for that is they don't have a strong network. If you take a strong network company, it's like Facebook or Airbnb. This is a weaker network. That's what I classify as, because competition can come in, switching cost is low, regulation at play, future technology is changing. And on top of that, I'm a little bit concerned about the dilution of shares due to RSUs and management options that have been issued.
Well, we're getting a little technical here. I like that we're discussing little g and k for cost of capital. That's for Tanya, our producer there, who went to NYU School of Business. Talk to me, though, a little bit more about the $2 billion that they are planning to raise. Where is that most useful for them to put that money to work?
I would think it is CapEx. CapEx is the most important thing for them. People are calling that 911 million net losses as a big loss. I do understand. This is the largest loss a company going public. Snap went public at $500 million loss. But this is an accounting number. When I look at the operating cash flows for this company, they had about minus 300 million. They lost about 300 million operating cash flows. So their major focus is going to be towards future technology. They are building driver hubs to facilitate for the drivers. So if they build a good relationship with the employees, that will serve them well. That will differentiate them from Uber or Grab in Asia.